Hey everyone, it's November 10th, 2015. In this week's video, I'll review the SPDRs ETF, take a closer look at some of these sectors that perform the best in a rising rate environment, touch base on the US dollar index, and end the weekly video by reviewing the move we've seen in the 10-year real interest rate coming off the 2012 lows. So first things first, the S&P 500. As I normally do, I've included a few Fibonacci retracements for important highs to corresponding lows. Um, and in doing so, I think this will give us a little bit more color as to what to expect going forward. As you all know, Fibonacci retracements can be used to pinpoint different support and resistance points across time. From experience, I've noticed that Fibonacci retracements are much more precise in the Forex market than in stocks, but nevertheless, you can still use Fibonacci retracements to assess market conditions. Personally, I think this is a great tool to again give us a better understanding of what price did in the past, given a certain circumstances and events, and how price may possibly evolve or behave in the future given uh, past price performance. So what I've done here is drawn three Fibonacci retracements from important highs to corresponding lows. And in doing so, three important price points came to light. First one is 217, followed by 207.61, and then the following is 221.41. So basically, those are the three big macro levels you as a trader or as an investor have to keep a close tabs on. For this rally or for the move we saw in October to really have staying power heading into year end and more importantly, transitioning into 2016, personally, I would say from my point of view, 207.61 has to hold on a closing basis, on a month-to-month closing basis. Doesn't mean it's perfectly okay for the S&P 500 to trade on any given day below 207.61, but you're truly to see a change in the composition of the overall trade, where essentially people stop buying dips and selling rips, which is really, it's been really the theme all year long. And really, they change mindset and they begin to pay up a higher multiple or a higher price point for many of these stocks. Then I think we could have a different market going to 2016. But for that to happen, I need to see 207.61 and SPDRs hold into year end. If 207.61 doesn't hold, then any 198 to 200 absolutely needs to hold for the move we saw in October to have any validity whatsoever. And only a close below 198.07, which is the midway point to the most recent range. If that gets taken out, then I wouldn't consider shorting the market, but it's definitely a point in time where you have to sit on your hands, become a spectator more than anything, an observant of markets before you place your next trade. Only a closing, whether it be daily, weekly, or and monthly closing below the current higher weekly low between 1910 and 1920 would really sort of induce me to get aggressively or overly short some sectors that I consider are a bit overpriced to current and projected earnings. But as of now, if you were to ask me, David, what's your take on the markets going into year end? To be quite honest, I think it's going to be muted. And by that, I think the upside and downside is very limited. I consider November, December to be inside months, even though November we made a new high, and we haven't really stayed within the range of October. And the point I'm trying to get across is that November, December are likely to be likely have very small trading ranges. So they're, in effect, in a way, they're going to be inside months, even though November can't really be characterized as an inside month. But nevertheless, they're going to be very small ranges as people try to sort of chew and mull over the move we got in October to see if, in fact, it marked a change in trend, which could lead to a different market going forward. So if we take even a closer look and look at the weekly, the levels I'd be watching for are 201.76 and 198.07. I mean, this price span over here is where, if you're lucky enough and you haven't really participated to the upside, which believe me, a lot of people have not, then that's the ideal entry point. But do recognize that a closing below 198.07 does not necessarily negate the move we saw in October, but it does sort of tilt the balance of the trade back to where it was, meaning there was basically 50-50 odds of markets trading higher or lower. And trading being everything about probabilities, it's probably not the best spot, even though from a pricing perspective, you look at price alone, that the price band between 198.07 and 201.76 on the spiders, that's the ideal entry point. But you think or take rather, excuse me, other points into consideration, one of them being probabilities, and weigh them to price, you'll see that it's not the ideal entry point until it's confirmed. So, what would be the ideal setup for market bulls? There would be two. One is that last week marked the beginning of a new consolidation phase in the markets, which has the potential to extend up to May. That doesn't mean this consolidation phase will last up till May. It just has the potential. And it consolidates at the upper end of the trading range between 2016 and 2133 S&P 500. The second option is that you get a swifter price decline down to important levels, notably 2060, 2045, and 2016 on the S&P. If price gets retested at all those levels and price holds 2016, which I consider to be the most important level, then what would essentially be happening is a series of higher lows and higher highs would be established on the daily time frame. If you remember, what really characterized 2015 was a lack of direction, bias, and momentum. If this were to, and I'm talking about all these in the short term, so if we were to get a retest of 2016 in the S&P 500 and proceed to trade back above 2045 and 2060, that would basically set the stage for a series of higher lows and higher highs to be set on the daily time frame, and that would mean the short-term trend would be to the upside, and so would bias and momentum. So that would definitely be a bullish, add to the bullish undertone currently present in the markets. Now, what are the risks? The risk under scenario one, where the S&P consolidates up through May, is that if the S&P does not make a new all-time high or new 52-week high by May, then there's a growing risk that what we're seeing in the S&P 500 is a brand new top forming, where essentially, you're getting weaker hands selling into stronger hands, and masking this as what many perceive to be consolidation when it's really distribution. So even though if the consolidation phase were to extend through May, we don't have a breakout by then, that doesn't mean you short the markets right there and then. You still have to see, ultimately you have to take your cue from price, and only a trade again back below 1910 to 1920 on a failed breakout attempt above the current highs would really show me the hand of the market, and lead me to believe much lower prices are probably going to be contested. As for target points, I mean, if such a scenario were to take place, I would target 1660. Oh, initially I would target 1880, which is the current low, the present low, followed by 1780 and 1660. And as you recall, or as you may recall, 1780 and 1660 were two price points I routinely pinpointed to, because those are really, really important price points as represented in time. So if the S&P were to break below 1910 to 1920, 1660 to 1780 are the two initial price points you want to focus in on. That doesn't mean the markets, or the S&P rather, is going to bottom at 1660. In fact, it has room to trade down to 1460 But all things considered, those are the two initial price points you want to focus in on. If on the other hand, the S&P does break out and the current move off the October lows is not only reaffirmed but confirmed as a higher weekly low, then what we'll see is a projected move up to this point, which I mentioned at the beginning of the video, at 221.41. That's roughly at around 2210 on the S&P 500. So the first price point you want to focus in on to the upside is 2181 to 2220 on the S&P 500. If the S&P 500 does not spend a considerable amount of time consolidating between 2181 and 2200 or 2220, excuse me, once it gets there, then there's a real chance or there's a higher probability of the index trading as high as 2350 to 2410. Not necessarily in 2016, although it could happen, but the carry momentum should be enough to push the index as high as that price point before we reach another important inflection point. So that's really all I'm going to say about the S&P 500, and that's some of the things I'm watching for. Again, this is all the information we can possibly consider from a Fibonacci retracement study. Of course, if you apply other studies, it will give you more information, but the reason we're doing these weekly videos is to get a little bit more color as to what markets may do in the future. If you look at sector-wise, in a rising rate environment, what are the three best performing sectors? Well, the three best performing sectors are information technology, financials, and consumer discretionary. Consumer discretionary, think automakers, cruise liners, hotel operators, restaurants, and so on and so forth. What I find curious and interesting, and this is not a coincidence by any means, but what's really fascinating is that once the market set a low, or what appears for now at least to be a low coming off the late September low, was that all three of these sectors led the markets, and specifically the S&P 500, higher. In other words, these three sectors are the leading sectors over the last month. And even more importantly, if you take a look, whether it be a weekly or monthly chart of each of these sectors, you'll notice, as I'm going to show you, that each of these sectors has successfully broken above its former high. Except for financials, which is still hovering below its high. But if you look at technology and consumer discretionary, these two sectors are trading above the high. So what does this mean? Obviously, first, it shows relative strength. It shows a higher degree of commitment, conviction by traders of all walks, big, small, whatever it may be, of essentially paying a higher price for some of these stocks in these sectors. And that's important because that's something that wasn't present at the beginning of the year. Because remember, what really characterized the trade at the beginning of the year was buying measured dips and selling rips, some of the best performing sectors, and selling short some of the weakest performing sectors. That changed in August when essentially the buys was to sell short the rips and buy back at a lower price level or on a dip. And today, for now at least, again, this is subject to change into confirmation, but for now at least, it seems that there's a high degree of commitment, conviction to pay a higher price, not just sell whatever rip we get in the markets. So that's an undertone that wasn't previously present. So let's take a quick look at the technology sector. Technology sector, again, I drew an important fib retracement, or a couple of fib retracements, and the three most bullish aspects about this chart are the following. First, the original trend line that began in 2011 was broken below in August, contested multiple times, but noticed that it never really traded or closed below this trend line on a week or let alone a month-to-month basis. So the fact that buyers stepped in aggressively at this price point, which many can perceive to be important, I really don't think holds much weight, but people perceive it to hold a lot of weight, so I still consider it important. But in any case, buyers convened at this price point multiple times, And what resulted was a sharp rally where buyers essentially who missed this initial buying opportunity, paying up a higher price, and short sellers uh, covering part of their positions. That's the first bullish aspect. The second bullish aspect is that these important fib extensions, which really showed carried momentum in the markets, all held. If these Fibonacci extensions from previous ranges were broken below, were broken and closed below, that would to me show that the speed trade, the momentum trade that has really defined the market since 2011 is over, and that would be very very important because again it means that the momentum trader, the speed trader, is no will more likely than not be present, and that's going to change the entire mentality of the markets. So to see those important price points, which again let me remind you are not to be used as support points. Fib extensions are just projected price points represented in time and across space. It doesn't give you, you shouldn't treat them as support and resistance, just projected price points. But whatever the case may be, that's a very bullish undertone as well. Going forward, I would say 4282 is a reference point I would use to measure the recent move off the lows, off the September lows, and into a new high. 4282 manages to hold into what promises to be consolidation phase, at least into the beginning of December, middle part of December, and this price point holds, that's a very very bullish undertone. If there's going to be continued momentum to the upside, then 50, 51.57, 54.10, and 56.98 are three other reference points you want to pay close attention to. Again, those are not targets, and they're not to be used as resistance bands. They're just there as reference. If you look, okay, finally, before I go over, what are my favorite stocks in XLK? Well, I would largely stick to big cap, although there will be some opportunities, and there's some opportunities in small cap tech companies. But by and large, you want to stick to big caps names, such names like Intel, um, Microsoft, Google, Amazon. Basically, companies that are well diversified, have different means of attaining different revenue streams, and companies that are able to streamline whatever new product or service they're willing to offer to customers. Um, and also, more importantly, you want to be in big caps because most people have had this idea, and rightfully so. But for now, though, that a stronger dollar is a headwind to corporate earnings, and again, that's been the case so far. But that's you have to, like everything works in cycles. You have to understand that a stronger dollar initially at the beginning of the cycle acts as a headwind to corporate earnings. But towards the middle and latter end of the cycle, which is the part we're approaching, um, within the cyclical bull market in the dollar, the the stronger dollar actually acts as a tailwind, as a boon to corporate profits. And it only acts as a boon to corporate profits to big cap companies who are able to diversify their assets and hedge some of these FX changes much more better than a smaller company does. All be told, also they generate a bigger share of their revenues from overseas. So by having a devalued currency relative to the dollar overseas, that's going to help boost their um, their numbers, whether it be revenue, sales, operating efficiencies, or whatnot, overseas. So there's a lot of things to be excited about in big caps, specifically in tech. Even if this dollar gets stronger, so just be mindful of that. If you look at consumer discretionary, it's also a very similar chart, and here we have the same thing. A bullish aspect is the fact that the trend line dating back to 2011 has held. It was contested multiple times, but it held, and we're trading at a new all-time high. Very similar to the XLK. The next important point to consider is 83.53. I would judge the strength or the staying power of the recent move above the highs at 81.40. If this level holds in, for the most part, as the markets consolidate or possibly contest lower price points, that to me would act as a very bullish sign. Um, And as far as financials, oh, before I move to financials, excuse me, what are my favorite stocks in consumer discretionary? Where if you're looking at automakers, GM is probably one of the better options you have with a 4% dividend yield. Um, and the company recently announced improving numbers out of China, United States. That's the name I would gravitate towards. If you're looking at something like a cruise liner, Royal Caribbean, or a name like Norwegian Cruise Lines will also do the job. If you're looking at restaurants, I would personally stick to mid-tier restaurants, meaning names like Zoe's restaurants, Panera, Chipotle. Those are the type of restaurants. Even a Denny's, a Wendy's could do well. Those are the type of restaurants I would focus in on because most people would assume that if rates are rising, the country as a whole, at least from an economic perspective, is doing better. So people have more disposable income and blah 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 and all this other stuff. I mean that may be true, and certainly a strong dollar will act as a tailwind for the U.S. consumer. But disposable incomes are going to be much smaller than what they were a few years ago. So, and not only, I mean, yes, disposable incomes are going to be smaller, but also people's attitude and approach towards spending is also being they're going to be much more apprehensive. Um, so, the point I'm trying to make is, yes, the consumer might not necessarily over the next 2 months be more willing to spend because it hasn't really hit them yet. But if you wait another 6 months, they may be willing to spend a little bit more, but they're not going to be spend as much. They're going to be much more again apprehensive and cautious with their money. So if they do dine out, they're not going to dine out, at a very expensive restaurant. They're going to do so at again mid-tier restaurants like a Denny's, a Panera, and whatnot. So those are probably the restaurants you want to focus in on. And again, financials. If we take a quick look at financials, from a charting perspective, is perhaps the cleanest chart. Um, Unlike the XLK and the XLY, however, tech and consumer discretionary, this index has not broken to new all-time highs. It's still hovering below current resistance, and it broke or trading below the rising trend line that dates back to 2011. It is, however, trading above the rising trend line that dates back to the original trend line, that dates back to the 2009 low. So that's bullish. Um, Personally, a lot of people would gravitate towards Bank of America in a rising rate environment. But personally, I just, Bank of America is a shady entity because the company has so many bad loans on its books that nobody can properly assess with current accounting practices what the company's worth or what some of these loans are worth. So if you really can't assess part of the ledger, right, from a company, how you're able to assess the net worth, the enterprise value of a company, it's really hard to. So, it's Bank of America has too much systemic risk that I'd rather avoid. So, but it's probably going to turn out to be a good way to play rising interest rates. But personally, if you're looking at big cap name, I would personally look at a Wells Fargo, who also has exposure to the consumer, or my favorite, BK, which is Bank of New York Mellon. Uh, you could also look at some of the regionals, such as Regions Financial, Ozark Bank, and whatnot, as alternatives. So, going forward, if the S&P 500 is going to make any attempt at a new high, these leading sectors, which again are info technology, consumer discretionary, and financials, which you know it's not by coincidence, but it's just by design, were also some of the or excuse me, are also some of the best performing sectors, or have been some of the best performing sectors in rising rate environment. Those have to continue to perform, at the very least, part to the performance of the S&P 500, if not outperform. And essentially, they have to become or continue to be the market leaders we've seen over the last few weeks, and other sectors that do not perform as well, which include industrials, materials, energy, telecom, utilities, and whatnot. They have to um, not necessarily perform up to par to the S&P 500, but not hold the entire index down. And that's a real risk I see, at least in the near future. Um, as far as the U.S. dollar, I mean, the U.S. dollar, and I've said this for a long time, is in a cyclical and a secular bull market. Just very briefly, the break we got last week was important but it doesn't mean new highs are afoot. I would measure the current move off the lower end of the trading range by essentially measuring how long the index can sustain the recent move above its midway point or the 50% fib retracement. As long as the UP or the US dollar index holds above 25.34, it's really hard to bet against the dollar. I've said it from the very beginning. I think the best way to trade the dollar long is to go long a dollar fund. Or you can also go out and short a bunch of emerging market currencies, which are not positively correlated with one another. That's a very, very, very important part of it. If they're negatively correlated, then it won't work. But if you're positively correlated, you could eke out a gain. But again, the easiest way is to just buy the dollar fund. And quite frankly, I just don't see how the dollar doesn't get stronger. And, I mean, I'm not calling for a similar move to what we saw in 2014 up to March of this year, where we saw a shot up or runaway market. But I just don't see how the dollar gets progressively stronger, little by little, really extending into 2020. The euro is pretty much foregone conclusion it's going to hit parity to the dollar, be it in 2016 or 2017, especially with the ECB's idea of introducing or bringing forward negative interest rates. So it's just not. I just don't see how the euro is going to strengthen any more than it already has. And especially, I mean, if interest rates are set to rise in the United States and possibly the United Kingdom, people are going to swap out some of these currencies in response of the movement in interest rates. They're essentially going to go into the higher yielding currency, which again would be the British pound and the US dollar. So US dollar looks perhaps it looks even better, I would say, than equities um, going forward. Finally, the move we've seen in the 10-year real interest rate coming off the 2012-2013 lows is important to take note of. Many people are fixated over the nominal interest rate on the 10-year yield, for example, but very few have focused recently on the move we've seen on the 10-year real interest rate, which accounts for inflation. If you look at any other developed economy or market out there, Germany, Japan, the UK, whatever it may be, you'll notice that over the same time period, since the end of 2012, beginning of 2013, every developed economy has seen their negative real interest rate decline by over 100 basis points, whereas in the United States, the real interest rate has increased 500 basis points, again, during the same time period. That's that's first I thought it was unimaginable, and it's shocking more than anything because it shows you that there's a guaranteed future premium to investing in the United States, specifically on the equity side, than anywhere else. That doesn't mean we're going to have a runaway market in 2016 and beyond, but it does mean that there's a higher implied premium or essentially embedded into forward returns one could expect to receive in on the equity side in the United States. So really, the rising the rising yield on the 10-year real interest on the 10-year yield sort of purports that three things: the idea that the dollar is strong and going to get stronger, that interest rates have already been discounted by the market. So this idea that the market hasn't really discounted interest rates, a possible rate hike being in December or in the first quarter of 2016 is bogus. The market has already discounted this. And third, that there's a higher degree of willingness by investors all over the world to invest in the US dollar, again, because of the added benefit of a stronger dollar and rising interest rates. So that's something to take into considerations. Again, something that caught my eye. So hopefully this will give you a little bit more sense as to what to look for. Personally, I think markets short term. If you look a few days, even a few weeks out, certainly extending through Thanksgiving, they're a bit of sort of no man's land. It's very hard to say if the market's going to pull back and retest some of those levels I mentioned before on the spiders, or if we're just going to wobble around the higher end of the trading range between 2045, 2060, and up to 2133 through month end and possibly year end. Because of this, there's personally, and judging from what I see in the market, there isn't really that high a degree of a conviction and commitment yet to price markets higher or lower. Yesterday's move lower was more of a reflexive approach or reflexive type of correction where people respond to the you know to the extraordinary move we got in October. So I wouldn't really read into it too much unless we break below important support points, which again will completely change or bring us back to where we were again at the beginning of 2015. But everything considered, I think this is a good time to be an observant and a spectator of the markets, at least through Thanksgiving. With that said, the undertone to this market is bullish. I wouldn't necessarily open new short positions, but at the same time, I would be very hesitant to open new long positions that are short dated, mainly because there's no confirmation yet that prices want to achieve higher levels. So with that, be mindful of the fact that markets are likely, this is a time of the market. The market can test that everyone's sort of commitment and conviction on the way up, right? People, people that were lucky enough or smart enough to buy at or near the lows in September. The market essentially contested their commitment and their conviction by with that runaway market we got in October. Some people bailed, some people stayed the course. Now comes a time with the market trying to figure out if it wants to trade higher or lower, where you, the investor, can sort of test the market and see what price points are mostly transacted, and see if there's a large degree of commitment at around different levels. If you begin to see commitment and overall again change in mentality how investors want to approach the market, then perhaps you can participate and get it at a higher level. But if not, again, you have to remain very prudent, very skeptical about any move higher or lower until price confirms it, until there's a high degree of involvement really in the markets. So with that said, be very careful over the next few weeks. This is a part of the we're entering this part where the market, it could be fairly easy to make money, but it's a fairly very easy time of the year where you can lose money because of the lack of conviction. So just be aware of that. Um, I want to thank you for taking the time to watch a video, and I will talk to you next week.